Hey guys, Jay here. Welcome back. We got another financial model template. This is smarthelping.com. I've been building these models for over a decade. This one here is quite interesting. It's got some new things I've never modeled before in this exact way. It's mainly for a real estate acquisition joint venture, and typically, or more specifically, for an assisted living facility. Now, it could also be used for essentially any business project where you're doing real estate plus the actual business operation, and you'll see why when we get into the types of loans. The assumptions for the operating part are fairly simple. We just have, a simple NOI calculation. The debt and acquisition and preferred return slash joint venture is where things get more complex. You'll see we've got a cash flow detail here, lots of visualizations, preferred return waterfall with a lot of different configurations here. And then all the debt logic is happening in L2 1 through 3. Okay, so let's dive into the granular aspects of the model. Um, First, you can enter your revenue of the expected project here for up to 10 years. You could enter the salaries and wages and other OPEX. That gets you total expenses. You've got an expense ratio calculation. Then you've got net operating income, which is just the cash flow the property produces. Now, you could also use a manual expense ratio if you select this to be yes, and that will adjust it so the expenses take this percentage rather than the hard-coded expenses here to calculate NOI, and that will dynamically affect the entire model. We'll just leave this at no for now. Here we've got some general assumptions which are important for the debt modeling, so make sure when you input this. So close date, you want to use the first day of whatever month it is. So and you want that to always match the origination date here if you are going to be assuming a loan from the seller. If not, then that's okay. You just need to put a date in here, and it's not a big deal. Units here could be relevant, might not be. There's not a whole lot tied to this. Uh, I don't think there's anything tied to it actually. Just for reference, hold period here definitely you could define your hold period up to 10 years. You could pick any number, and you can see all the numbers update here on the waterfall, on the cash flow waterfall. If we go back to 10, you see here we'll go up to 10. So here we've got, some calculations to figure out what we can borrow and what we're using money for. So the first number here, RE budget total, this is used for the SB 504 loan basis, which is just for the real estate part. There's two loans. Well, I guess there's three types of loans. One is SBA 504, which is either going to be a new loan that you take out, or you're going to assume the loan that the seller has. Um, so SB 504 is for the real estate. SBA 7A is for the business portion, and usually the limits on these loans are going to be somewhere around 5 million each in general. And so here we say the SBA 504 loan amount, if we're using that, is going to be based on a percentage of the RE budget. So we have a percentage based on that. Total fund here, 6 million. We have basis for 7A loan calc is then the difference. So this is the business portion essentially, uh, and then you could put the percentage of that that you want to borrow. Okay, then we have our actual costs. So real estate purchase price, business purchase price, acquisition fee, other funding, property management fee, asset management. This is for the GP if they're going to charge a fee. Um, or no, sorry, this is. Let me look here. Did I put that in as a fee? Yes. So that is part of a fee the GP would take if you are going to use it. And it flows out of the deal, out of the property operations as an expense and into the GP's area as an income item. The amount of money you're going to raise here. Now this is interesting. If you put 0, you can see the cash reserve, or essentially extra, is negative 2.9. So that's what you need to get the deal done after accounting for all expenses, startup costs or acquisition costs, and sources that you currently have. So we know we need 2.9. Maybe you want a $250,000 reserve, so we put somewhere around 3.225. That'll give you about $250,000 reserve. Now this amount here is going to drive the preferred waterfall and how much total equity is coming from the LP versus the GP. Okay, now the fun part with these loans. So you can do the 504 and or the SBA 7A, depending on what the deal is. You can always zero these out if you're not using them, and that's no problem. Make sure if you do zero them out, you also zero out, like here we have lender legal costs. You want to zero that out, and that's on all of these here. Then we have a refi. So you can refi at some point in the future, let's say year 4, and if you are going to refi, it refis all the loans into one big loan here. And so the refi amount is going to be based on the value of the property, based on a cap rate. And again, these numbers are all arbitrary that I put in here. They don't mean anything. When you fill this out, you'd put your own information in here based on your scenario. But here we say, yeah, we're going to refi. We also have a calculation to show if at the refi there's still an LP equity balance or not, which is usually important. Here there is still a balance. Obviously, they're not getting, their equity balance isn't actually going away until, let's see, month 6 in this case. But in month 4, when we refi month 4, there's still quite a bit of a balance for the LPs there. And then we go on here, obviously the refi, there's a whole bunch more cash left. Your debt service went from 189 to 200. We've paid back these loans. Well, actually, sorry, we went from 338 because both the loans refied into this other loan for 213. We just basically paid these loans off with, and again, the assumptions are arbitrary, but we barely made cash positive for the refi. Usually your refi, you're going to have a big cash surplus. It's just the way the assumptions are here. There's the refi amount's lower, but the debt service goes down in year 5, so we got a bunch of extra cash to distribute. So that's why the LP in this case is not really getting taken out until, well, year 6, and then year 7 it finally goes, they've been paid back, all their money plus the pref. Now there's a couple, I'll show you some different ways to use this preferred return model once we get through these loan scenarios. There's also the exit cap rate and selling fees. Now if you are going to assume the loan, you can put yes here. And what the model is doing then is modeling this entire loan from the origination date relative to this close date, so we know where we actually are in the repayment of this loan on the correct month. And so we have to know the original balance, assumed loan interest only rate, IO period if applicable, if there was one. So you're just trying to recreate the old loan. And then after the interest only period, we have your regular amortization inputs. And then that still is subject to refi if you do refi. So you can see here on the cash flow detail, we've got an assumed loan. This is the debt service payments, principal and interest based on where we were in the life of that loan. The SBA 7 loan proceeds. Now note the assumed loan, there's no proceeds coming in because you're assuming a loan. You don't get proceeds. The SBA 7 is obviously a new one. Here's the debt service. There's the refi. Um, let's kick this to year 5 and see what this looks like. Still not enough to repay. I just want to do a scenario where we've got enough. Let's do no here. What else did I change? Here you still got 3.63. Let's put the cap rate a little bit lower, 15%. Okay, so there you can see we paid back the refi or the LP in the refi year. We still got a decent cash flow. Debt service went from 338 to 320. We paid back all of it plus a little bit of extra cash here for year 5. Okay, cool. So yeah, the loans are very dynamic and flexible. I've never done this assumed loan logic before. This isn't something new. So that's interesting, especially with an acquisition model. You might need to model that. So you've got that, the 2 different types of loans here, and then a refi of every type of loan all at once. That's also new. Usually with these models, I just have a single, either development or acquisition loan, and then IO period that gets transferred into possibly amortization, and then a refi or 2 after that, but not with 2 different loans with different terms getting refied. So, I always love to model new things because it just allows me to cover more scenarios and more potential use cases for people. So that's good. On the cash flow detail, you just have all the property cash flow. So acquisition fees, this would be GP income, any gap funding, the net operating income, the asset management fee. Then you've got all the loan cash flows here for SBA 504, all the SBA 7. And note, if you do turn this on for assumed loan, whoops, down here, this will change to assumed loan instead of the 504. The verbiage changes correctly, automatically. Then you've got your refi and then exit. So pretty straightforward distributable cash flow. We've got debt service and debt service coverage here for a reference calculation, and your cumulative cash flow after raising funds. What else? Charts net operating income, distributed cash flow, debt service coverage, LP versus GP cumulative cash flow, LP versus GP returns. So the equity multiple and IRR of each based on the waterfall and the preferred return. LP and GP cash flow per year. So if you sum up all these per years, you get to this cumulative chart up here. And then sources and uses pie chart. What else? So this cumulative cash flow, you are about 10 million higher than the well, this is an accumulation of all this, so you can see if you add it up, and then the difference would just be the amount of funds raised. So if we were to sum up all of these, this minus this equals 3225, which is how much you raised. Okay, now the preferred return waterfall. I've spent, and this logic here has been 5 years in the making on its own, just this to be able to work like you see. So you can put the percentage of the equity contribution that the LP and GP are contributing. It could be anything, maybe 90-10, 100-0. Now if it's 100-0, the GP will not have an IRR because they're not contributing any money. Let's say it's 95-5. Tier 1, this allows you to change how the cash is split up until the preferred return has been paid back. And that's not preferred return plus equity. That's just the pref. So like this amount right here, this defines how cash is split between the LP and GP until these accumulated totals are fully repaid. So here we just have all the cash, which is normal, going to the LP. But you might have, if you want to split it pari passu, you could do 95.5. So in that case, the GP is actually going to get a pref as well at the same rate if it is pari passu. Then tier 2 is how much cash goes to the LP and GP based on the LP's equity being fully repaid. So this is cash flows after the pref, but before equity is repaid, and we're defining that split right here. Now, often you'll see a situation like this where it's 100% to the LP, 100% to the LP, they've got all their money back, and then tier 3, it's you take out the LP in this case because you do 0% for tier 3. And 0%, just do like an immaterial number. You got to push through the model, so you need like, a bunch of zeros at once, so it's essentially 0. And if you do that, the IRR will actually equal the pref, if assuming there was enough cash flows to get to get past tier 2 and into tier 3. So you can see if I change this pref, the IRR is changing for the limited partner. That's because we are compounding any unpaid returns here. We're reducing the equity balance with any amounts above the pref, and we're not clearing any unpaid returns. So in that case, the preferred will equal the IRR for the LP. Now if we put this pari passu, we still have, you see this is still, let me see if this still equals this. No, it doesn't, so it's slightly different. And if we went 95 here, let's see. No, okay, it's barely different. So for all intents and purposes, it's still going to match the pref here. And I guess that makes sense because even if they're not getting 100% of the cash flows, they're still getting a compound on the pref amount, which all that really matters for the IRR is how much is the compounding amount, and are they getting that paid back eventually. So this could be anything really, these percentages, but the amount that's going to the LP is going to drive if their IRR is the pref. Now, if they have upside here in tier 3, let's say you get 10% upside, it's 100, 100, and then you're giving them 10% after. Now the IRR is going to go beyond the pref, assuming there's enough cash flows to do that. So there's a lot of different ways you can play with this, these assumptions and inputs, and all this will impact the cash flows and equity multiples of the LP and GP. We got discounted cash flow down here, put in the discount rate. So yeah, I think this is a really cool underwriting tool. I've got a lot of new stuff in it. It's a nice layout, interesting layout. I've never done it exactly like this before. So yeah, if you want to download it, you can go to smarthelping.com. The template will be obviously in the, let's see, if we're on the home page, it'll be in the real estate bundle. You can buy it individually, which I'll have it listed in here, or you can buy the whole real estate bundle and get that plus all these other underwriting templates and tools and joint venture models. I don't think, I was going to, no, this is fine. This is perfect. I don't think I'll put in any other bundles. Well, obviously it'll be in the Super Smart bundle. That includes every single template on the whole site for $4.99. But I don't think I'll be putting it into any other bundle. So just a real estate one and into here. I think that makes the most sense. If you want to hire me to build custom spreadsheets for your own situation and walk through assumptions and talk through the unit economics, I do all kinds of models, not just real estate. Usually much of the work I do is bottom-up assumptions, and I also obviously do a lot of joint venture work, loan modeling, all sorts of things. Anyway, my rate's $275 an hour, prepaid. Email me if you want more details on that. Alrighty, like and subscribe. I'll see you guys on the next one.